So when evaluating apartment buildings, there are three main metrics, which is the cap rate, the cash-on-cash return, and the debt service coverage ratio. Now, these are important to know, but I'm not going to cover them here because I already covered them in a previous episode. So if you scroll down a little bit below the video, there should be a link to that previous article. So you need to know what they are, but they oversimplify the process, especially when you're talking about a value-add deal. Now, what's a value-add deal? Value-add deal is where there's something not right with a property. So, for example, maybe the rents are low or the vacancies are high, or there's something not right. There's a problem there that needs to be fixed. And when you have a situation like that, then some of the basic conventional metrics start falling apart. Now, why is that? For example, if you do a value-add deal where the rents are low, for example, the first year cash-on-cash return might be very low. It might be 4%. Well, is that a bad deal? Well, not necessarily. Right? Even though we want to be at a 12% cash-on-cash return once it's stabilized, right? Is it a bad deal if we're buying at a 4.5 cap? It doesn't sound very good, but what if it's a value-add deal? So how do we address that, right? And the solution to this is really the ultimate indicator, which is the average annual return. Now, what is the average annual return? The average annual return looks at the return of the entire project over the entire time you have it. It really consists of three parts. One is cash flow, right? So this is money coming in that's left over all expenses. That figures into the average annual return. Then the second one is appreciation. So this is if you're building value, as your value goes up, as your income goes up, your value also goes up. That's what we call forced appreciation. You're forcing appreciation by increasing the income. The third one is amortization, or basically repayment of debt. So as you're holding this building for 5 years, your tenants are paying down your mortgage. And all three of those, when factored in together, make up your total return or your average annual return. So in order to calculate, so if you want to have a meaningful analysis of a deal, you need some kind of financial model that looks at all these components over that 5 or 10 year holding period. So what you need to do is you need to get or create a good financial model. Now, this financial model should have a 10-year projections. It should take into consideration your acquisition assumptions, your holding assumptions, the value that you're building. So let's say you're raising rents, it should model that, or lowering expenses, and then your disposition, right? And ideally, if you're doing it with investors, which is what I teach, then it also needs to take into consideration the investors and how you split the deal with the investors. So there's a lot of stuff there. You can certainly create your own spreadsheet, or you can use mine. So I've created one called the Syndicated Deal Analyzer. Very affordable, very simple to use, also very powerful. If you want to use that, just Google Syndicated Deal Analyzer and use that. So anyway, I want to show you kind of how this works. If you put it all together, I'm going to use the Syndicated Deal Analyzer as a tool, but I want you to see the concepts behind it. So let me go switch over to screen and we'll take it from there. All right, we're here in the Syndicated Deal Analyzer, and again, you don't need this tool to learn the concepts. I'm just using it to teach you those concepts. So what we want to do is we're looking at a real deal. We're looking at the cash flow, the appreciation, and the amortization to calculate the average annual return. Now, if these numbers are a little different than the blog post that's around this video, that's okay. The concept is exactly the same. All right, so let me introduce this deal. It's a 20 unit here, where they're asking for 1.1. We got on a contract for 877. Now we're going to need about $2,500 per work of units, $50,000 total. Now we're buying it at a 7.5 cap, and we're going to be selling at a 7.5 cap. You see some of the expenses here. So fair market value kind of deal. And then here we're modeling an upside in rents from $600 to essentially $700 over the course of 3 years, because the rents are about $150 under market. But we have to make some cosmetics upgrade to get there. So let's look at each of the components. We can see here that the average annual return in your calculator here is showing a 15.8% return for the investors. Now the investors are getting 70% of the pie, and we as a syndicator are retaining 30%. The investors are putting up the money of $350,000, and for that they're getting 70%. You're retaining 30% of that deal. So the return right now for the investors is above 15% average annual return. Normally the rule of thumb is if you can keep it above 13% average annual return, investors will be very interested in talking with you about investing in your deal. So this is not a home run deal. It's a very nice base hit. You're buying it at a fair market value. and you're raising rents by $100 over 3 years, not a lot, you're not solving a major problem, but there is a value add component here. And you got to look at the average annual return, because let's look at each component. Let's look at the cash on cash return. If you look at the cash on cash return here, you can see that the cash on cash return is actually fairly low right here. So the year one, it's only 4%. Now, really, we want to be, for the investors, we want to get to as close to 10% as we can upon stabilization, right? This clearly does not qualify for that. But remember, we're solving a problem here. The rents are actually about $150 under market. It's not performing where it should. Now, as we increase the rents over the course of 3 years, we will be at what I call stabilization at the end of year 3, where we achieve our target rents. You can see here it's approaching 10%. So in year 4, we're at 9%. Year 5, when we sell, we're just under 10%, right? So we're approaching our target here. What I'm saying is the rule of thumb of cash flow now breaks down a little bit on the value add, because it's not there, because it's just not there, but it is there after 3 years. So that's the cash on cash return as a cash flow we're getting. Now, the second key metric that puts up the average annual return is basically the amortization, the pay down of the loan. So, for example, if we go here, all right, let me zoom in a little bit here. So in this tab, we're selling this asset in after 5 years. And so what you see here is you see the amortization. You see the principal reduction. So over 5 years, our tenants paid down $80,000 of the loan for us, which is very nice. And so that factors into the average annual and the total return as well. And then finally, there's the appreciation part, right? So the appreciation part is because we're increasing the net operating income by raising rents by $100. In doing so, it actually raises the value of the building as well. So you can see here, we're selling it for $1.2 million. We bought it at $877. So of that 1.2 number, $128,000 of that is forced appreciation, is the amount of money we created by increasing the income. So if you put this all together, here's how the components fit together. You have the cash on cash return. Let me go up here. You have the cash on cash return, which we talked about for the investors, starting at 4%, going to just under 10. So you have this here. Okay, and then when we sell, we have the profits from the refinance, and then of course the investors get their money back. So you have the profit of the refinance, and this profit here is the proceeds from the sale, which consists of amortization and appreciation. So you add all that together, and you can see here that based on the amount of money we put in, we're just over a 15% average annual return. Now, you might see the IRR here, this IRR thing, the internal rate of return. I also have it here, the internal rate of return. What is that thing? Well, that is actually a more accurate measure of return, and the sophisticated investors actually prefer it because it takes in the consideration of cash flows in, cash flows out, as well as the value of time and the impact of that on money. Now, I stay away from IRR, except for my own internal purposes, because most investors don't know what it is. And guess what? A confused mind says what? Says no. So stay away from IRR. You're certainly welcome to look at it, and I do look at it. It's especially relevant if you're doing a cash-out refinance or things of that nature. You have to use the IRR. So I don't want you to get caught up on that. This is why I talk about the average annual return. So while the three key metrics are important for evaluating apartment buildings, the ultimate evaluator is the average annual return. So get yourself a good financial model so you can calculate the average annual return over your holding period, and you'll be able to quickly determine whether it's a good deal or not. If you're interested in finding out more about apartment building investing, just click on my profile below, and you can see a list of all my previous apartment building investing resources and blog articles. If you have any kind of questions or comments, let me know below. Love to connect with you. All right, guys, appreciate it. Talk to you next time.